Futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I teach in my charting course or what I author in my twice daily oral and written updates. Prices shown on charts and quote boards are in real time and take into account all known activity up to this point in time. And if you'd like to read more of this disclaimer, simply hit the pause key on your video player.
Good day, y'all. Ira Epstein of Linn Associates with your financial market wrap-up for this Monday, the 29th of January, 2018, and we're just past 4:30 p.m. Central Standard Time. So as we're at it, tomorrow we have the State of the Union. We've got the FOMC meeting beginning tomorrow, ending on Wednesday. Then we get their announcement. Some traders are looking for some of the language to be a little bit more hawkish because of the big runs that we've had, be it on interest rates, the stock indices, and the like. You wouldn't know it with today being a correction day in the stock market, but in front of the State of the Union, in front of Friday's employment data, U.S. employment data, not a surprise the market took a break. And what about this month? It was basically a straight-up month. So seeing a bunch of traders want to maybe cash out and say, I had a great January, is that such a surprise? I don't think so. Looking at the metals, basically a day in the red, while the dollar was up a fraction and most currencies down a bit, but they certainly were not down at the day's lows. They all came off of those pretty smartly. When I say that we had an up time this month, you can just see on a weekly area chart how the market went up. If I take off so far right here to this week and just ended last week, you can see how you've been up 63 points last week. So you gave back a third of that today. Okay. Doesn't mean that anything's really over. When we take a look at the daily bar chart, you can see how the market in 2018 has come from here all the way up. So that is my definition. The traders might have wanted to lock in something today. You got a whole week full of data. Maybe they just want to take another look-see. In terms of the trend itself, let's take the name off the chart and pretend. You still have a pattern of higher lows, higher highs. That's bullish unless you take out 28, 25, 50, and even then it's not bearish. It just breaks an uptrend. When you take a look at what the 18-day average of closes is doing, it's averaging almost 8 to 10 points a day. So I don't expect it tomorrow to be up to this number, but it can get within, say, 5-10 points of it. Not a surprise. But to get down here, you would break the trend. That's my point. In terms of the upper Bollinger Band, is the market ready now to start leaning over a little bit? That's going to be the big question that we all ask ourselves. It could be. Maybe this thrust has run out, but until it's over, folks, it ain't over. So the thrust is still in place. The bullishness is still in place. The momentum of the market losing a little, but you haven't taken this red number and closed it under 80. And until you do so, it means that upside momentum, while it wavered today, it hasn't been broken. When we come to the NASDAQ, it's the same thing on the momentum. It's a similar pattern of higher lows, higher highs, still bullish. No change there. The Dow, locked in bullish momentum. Still the pattern of higher lows, higher highs. Admittedly, the market doesn't have the power that it had at the beginning of January. While it made higher highs, it couldn't technically get up to the upper Bollinger Band. Is that in and by itself a problem? Frankly, it isn't. All the market's done now is going sideways a little bit. When we come to the Russell, you had an outside day down. So I could take these two arrows and flip them now. I could have this, the first arrow pointing down here and the second one pointing down here. Why? I'd have lower highs. And what about today's low? I'll show you why I didn't do it. Today's low at 1597.10 did not take out 1594. So what you do is you don't do what I just said. These are still the proper arrows, higher lows, higher highs. I say this sometimes because I want to teach, and that's the goal here. Momentum-wise, we had, if you take a look at the momentum, you had both numbers over 80, both over 80, and both over 80 starting last Wednesday. That was lost today. When lost, unless it's regained immediately, the odds favor price is going to try to make a run for the 18-day average. Does it happen all the time? No. You tried it back here. It didn't work. You went up and made a higher high. Keep in the back of your mind that you're playing probabilities on a chart. Is the momentum up? No, momentum's down. Is the bias up? Yes, because you're still over the 18-day average. And the swing line hasn't been broken. Let's assume you break through 1594. Well, with momentum pointing down, the odds would be in favor that prices might, the word is might, I can't tell you it will, want to go back to that 18-day average to rebuild. In the VIX, the market soared today, back over the upper Bollinger Band. I made an observation last week for you. I said that I'm wondering if volatility isn't creeping back into the market. And I said that because when the market got up like this and didn't make a run for that 18-day average, I said something has changed. In the past, when we had a couple of days over the upper Bollinger Band, you normally went back there. You did it here, you did it here. And I recognized that something had changed. And what I said to you, and I'll stay with it right now, at this point at least, it appears that we've got a trade bottom in place and the market's trying to expand out a trade top. And that's just what this market was doing. Take a look. You can see today's action. It's exactly what it's done. Remember, when you're down at 9, if you break 10%, the problem is, what do you get out of it? When you're right here and the market goes up 25% today in value, that's correct. It went up 24.9%. You get a big splurge to the upside. It's very hard to get those kind of numbers from a low number. When we come over to TLT, the bond ETF, little caution warranted. You're oversold, you hit the lower Bollinger Band, and the market found support there. This does not mean the downtrend is over. It does mean the market's hit downside objectives, and like it did back here, I would not be surprised if this market wants to give a little bit of a bounce. The same thing in the bonds. But in the bond market, if we look at momentum, both numbers today are under 20. They were both under 20 on Friday, and they were both under 20 on Thursday and even the day before. So what we have is a market that has converted itself into a downtrend, locked in the bearishness, hasn't done that in a long period of time. You literally have to go back to last October to find that. And now the question is, if it rallies, will it find the resistance back up here? A lot of news today coming out, people asking, you know, we've seen the notes break through 272, but the bonds really can't seem to get over 3%. And yes, I realize mortgage rates that are tied to some of this are at a 4-year high, but you're just not getting the big yield. There's many reasons that that could be the case, including look at European yields. In the 10-year note, you got down to the lower Bollinger Band. You have a fully embedded reading. The market hit a downside target, found support against it, got as low as threw it by 2 points, and bounced away 6. Haven't changed anything. Still a very bearish market scenario. In the dollar index, up today 24 points, but you're still with the lower highs, lower lows. Admittedly, you hit the lower Bollinger Band, you've bounced to the right, but if the market can start taking out today's lows, you might get more momentum to go back to the lower band. Let's assume I'm wrong on that. So I look right here at 90.63.5, that average. The day before it was 97, 90, 93. It's been falling pretty hard. The odds are it's going to get underneath this 90.50 as early as tonight. So on rallies, that is where I'd expect the resistance. It fits in with the last high and so on. What I'll be keeping my eye on, do you lose the embedded reading or do you keep it? That's going to be important. In the March euro currency, as you can see on the close, you finished up losing the embedded reading. Prior to this, both numbers over 80, both over 80 on Thursday, and both over 80 on Wednesday. So you had the embedded reading, you lost it. Often, when that occurs, price and the 18-day average try to come together. Now, how much is this average moving a day? And all I do is take the most recent days to get a feel for it, and it's just a feel. I look at it, 122.31, 122.13, 121.19. So let's say 15 points or a little more than that. Even with a rally, you're not going to be over this number tomorrow. So you can afford to break more, and you might break the trend if you go through that. That's just mentally how I think. In the British pound, you lost the bullish embedded reading. Now, this market has been on a tear for the whole year. It started off flat, as you can see, came out of December flat, and then just launched. This is the corrective phase. Could it carry down to the 18-day average? Most certainly, but this number will be over that number in the morning, actually tonight when we reopen. So I wouldn't be surprised to see support there, but because you lost the momentum, you got to wait for the market to either get out of the overbought condition or give you a better reason to be in the market. The Japanese yen, still with the embedded reading. While the Bank of Japan keeps trying to verbally say things, they put their foot in their mouth more often than not. When they said that they saw inflation on Friday, it just sent the market again railing, and it hasn't given back any of that. Bitcoin, just sort of sitting here at the 18-day average, not doing much. When we come to the Brent, WTI crude oil, you realize it's at 388 now. When this market was up here and started down and got under the 18-day average, I told you, I think it's in a down thrust, and that the real game isn't in the crude itself, it's in the spread of the Brent and the WTI. I feel vindicated. It's almost down $3. Now we're getting to an area where it gets more interesting, because at some point here, if you subtract the shipping, they're not that far away. In the Brent crude itself, you fell back to the 18-day average. Momentum is pointing down. The bias is up and you're not trending. What you're really doing is setting up sideways action. You see the black dashed lines? They're the Bollinger Bands, the algorithm, and that algorithm gives you theoretical resistance and support. When the market goes sideways in them, you got to think of like a pipe, and you got a spring in it, and you keep winding it until it gets the force to break out up or down. That's what I think this market's trying to do. And that, by the way, was Brent. I hope I said that, not WTI, Brent. In this market, you really have, I can make an argument that you've got higher lows now. Right here, this arrow should be moved to point up. If you take out 64.91, then the odds favor the 18-day average comes into play. You did not lose your embedded reading today. You still have both numbers going sideways over 80, but it won't be able to withstand much on the decline side. I can see how the math is coming in on that, and it's probably ready to roll a little bit. Not yet in the rebound. While the momentum's being lost on the top side, you still have the higher lows, higher highs. It's acting quite good. The weakness came into the nat gas, and if you caught my morning update as a subscriber, I said, watch out right here. You got still in the makings of what? Embedding. Take a look. This is today. Both numbers are over 80. Both over 80 on Friday. Not so on Thursday. So you're in overbought condition where the first supports the 100-day average. If that gives ground, the 18 comes into play, and the question this week is, will it embed? Weather is a big factor here because we're about to get very cold in the Midwest for 10 days, and that's going to be, obviously, the way the jet streams go, it's going to be headed out east, and this market first looked at the moderate temperatures last night, and then it started reading the weather maps, and it caught a bid at the end of the day. I want to remind you, I talk all these technical indicators, and we have two big booklets for you. And we made them into PDF, so you're able to just, we can mail them to you, just print them out if you want them, or read them right online. It doesn't matter. But they cover the indicators I do here, Gann, Fibonacci, Elliott Wave, everything else that you'd want in there. And it's done in such a neat way that you're going to get a quick grasp of it all. How do you get it? Well, it's free. Just give us a call at 866-973-2077. Go to our website if you want by clicking here. If you're watching me on YouTube, it'll take you right to our forums. You can go to the website at www.iraepstein.com. And on a number of websites, if you click underneath me right here, it'll take you right to us. I'm Ira Epstein. You have a good day, and I'll see you tomorrow.